In this video, we will cover shareholders' equity, which we saw in the previous videos on the balance sheet. We have also seen shareholders' equity in the accounting equation, which has anchored us throughout these videos. In this video, we will specifically focus on shareholders' equity. In the next videos, we will see why this accounting equation is so important and why I keep coming back to the equation. Let's first talk about shareholders' equity. Another word for shareholders' equity is stockholders' equity. I use the terms interchangeably personally. Technically, shareholders' equity is used for talking about privately held companies, and stockholders' equity is a term used for talking about public companies. Public companies are companies whose stock are traded on the U.S. Stock Exchange. We looked at the financial statements for public companies, which were filed with the SEC when we looked at Netflix financial statements in the Finding a 10K video. Since I most frequently interact with public companies, I usually default to the term stockholders' equity, whether I'm talking about a publicly traded company or a privately held company. The definition of stockholders' equity is basically any assets left over after liabilities are paid, or here it says after liabilities are settled. This definition really points back to the accounting equation. If I were to do a little algebra on the accounting equation and shift it around so that liabilities were on the left side of the equation, that definition is really just saying stockholders' equity equals assets minus liabilities. I like to think of stockholders' equity as the items it includes. I'm going to use the accounting equation here to show you which items fall under shareholders' equity. First, shareholders' equity includes stock. Let's dive a little deeper on what is included in stock. You might hear stock called capital stock. There are two classes of stock, preferred stock and common stock. You don't need to know the difference between the two for this module, but if you just can't wait for your accounting class to find out what they are, then basically preferred stock gets first rights to any dividends before common stockholders can be paid dividends. However, preferred shareholders don't get any voting rights on major company decisions like common stockholders do. An important concept related to stock is additional paid-in capital, also abbreviated APIC or APIC. Let's get a little deeper into that concept. Stock is originally issued at par value. Par value is an arbitrary amount that is just established for tax purposes. It basically helps us identify the number of shares outstanding. That par value goes into the account we call common stock. Additional paid-in capital, or APIC, is the original issue price of the stock over par value, or we say the issue price in excess of par value. That excess over par value is going to go into an account titled APIC. Let's look at an example to try to make that a little bit clearer. Assume Aggie Inc. issues new shares out into the market. So these are shares through an initial public offering called an IPO, or through a later round of share issuance. The point is, they are coming straight from the company. They're new shares, rather than shares you could buy on a stock exchange that had been traded multiple times. Aggie issues 50 shares for $90. Aggie is going to get the whole $90 per share in cash, but on the balance sheet, $2 is going to go into common stock. That's just the 50 shares times the $2 par value. The remaining $88 of that share price is going to go into additional paid-in capital. We would multiply that per share amount of $88 by 50 shares, and that gives us $4,400 that's added to the additional paid-in capital account. The company still gets the whole $4,500 in cash. It's just on the balance sheet, we break those two values up between the common stock account, which is just par value, and the additional paid-in capital account, which is anything over par value. Let's go back to the accounting equation to look at the other components of stockholders' equity. Stockholders' equity also includes retained earnings. Retained earnings are an accumulation of all of the company's net income over time. From that amount, we subtract any dividends that have been paid over time. So retained earnings literally means just all of the earnings since the inception of the company that the company has retained. Dividends is what they've actually paid out to shareholders. So retained earnings is net income minus dividends, and it's a running total since the inception of the company. We used Coca-Cola as an example before when we were talking about the balance sheet. Their retained earnings includes all of the net income they have ever earned since 1892, their inception, minus all the dividends they have ever paid to shareholders. I'm showing you shareholders' equity in this format here with these boxes that you can fill in because I want you to see the different components of shareholders' equity. Since net income rolls up into retained earnings and retained earnings rolls up into shareholders' equity, anytime we have a change in revenues or expenses, that's going to have an impact on shareholders' equity. In a couple of videos, we're going to look at some common accounting transactions and how they impact this accounting equation. And I want you to remember that revenues and expenses are part of shareholders' equity. It's indirect. They first go into net income, and then net income goes into retained earnings, and retained earnings is part of shareholders' equity. But anytime our revenue goes up, so does our shareholders' equity, and that's going to be really important to remember. For now, let's go ahead and look at retained earnings in more detail. Retained earnings is a balance sheet account. So we start each year with a beginning balance. Remember, the balance sheet accounts carry over from year to year. Each year, we add the net income generated in the current period and subtract any dividends paid out to investors. We'll talk about this briefly again in the income statement video. So I want this concept to start sinking in, and then we'll review it again. Each period, net income is closed out into retained earnings. That means we zero out net income and move that balance over to retained earnings. So, retained earnings, which is on the balance sheet, is a running total of all net income. However, the income statement does not include a running total. It starts over every period. So net income as a number starts over every period and just gets dumped into retained earnings at the end of every period. And retained earnings is where the running total is kept. We'll address this briefly again in the income statement video. I want to explain it here to start planting that seed so you can think about it a little bit more. Let's go ahead and stop this video here. We've covered all we need to talk about with stockholders' equity, and we'll get into the income statement in our next video.